And joining me on the podcast right now and live on video, of course, for the new year 2023, Paul Hill. Paul, the big question is, will we drag ourselves out of this dreary market in 2023? Because it's now been close to 500 days since AIM, all shares is all-time high, and we're still in a bear market, and they tend to last, around its 12 to 18 months, and we're sort of in that territory area now. So big question here, Paul. What's your thought for 2023? Take us through the quarters, if you could, but quarter by quarter. What do you reckon?
I'm not putting my head on the block here, am I? Obviously,
no.
but anyway, I mean, I think if we take sort of big picture, where is the market sort of set up? And I think most people, if they've had a look at sort of where Wall Street are with the analysts and the big sort of investment banks, it's been a bear fest of sort of like predictions for this year. Very few of them are anticipating a sort of like a real stormer of a year. In fact, they're almost consensus, two really similar, as much, but all on the same side of the boat, that there's going to be a really tough first half and then a rebound in the second half. And I would like to say, well, yes, that might be in certain stocks. And the logic behind their case is such that you're going to get essentially a really tough recession in the first half. The employment's going to roll over, and companies are going to get defaults and stuff like that, and then we're going to get a Fed pivot in the second half. So an earnings recession in the first half, reset the bar. Then in the second half, you're going to get sort of like that Fed pivot, and then we'll set up for next year in 2024. Now, my personal view is that I just think everybody's on the same side of the boat in terms of where they're going to be. And I would suspect, actually, that isn't going to happen. In fact, I could actually see quite the opposite. I could see sort of like a fairly flattish sort of like first half. And then I could actually see a sort of reasonable second half, but I would predicate it that it's going to be a stock pickers market. It's a great environment, I think, to really sort of like look at, because what we've had over the last 18 months is that all boats largely have fallen with the tide as the Fed has sort of ramped up interest rates. And what that's meant, that it's been that we've talked about it a lot, the baby in the bathwater. And so coming back to your question, I'm going to split it into two halves, not the first half, second half, and not quarters. I'm actually going to split it into big cap, small cap. And I can actually see, when coming back to your sort of like, your observation that we've had a bear market in all things small cap and AIM for 18 months, I actually think we've bottomed out, and we've got sort of valuations, and the mean valuation of PE multiple sort of AIM round about sort of 10 to 12 times, and earnings are growing at that sort of like percentage as well. So PEG ratio around about 10. So there's really good value in there. But I would say on the other side of the coin, you've actually got quite a bit of damage still to happen in the mega cap tech. And I've been doing a bit of digging, as you'd expect me to, because I'm a bit of a saddo over Christmas and stuff like that. I've been looking at sort of the mega cap sort of like, giants, etc. And I still think that there's some way to go in terms of, a downdraft on the S&P 500 with likes of Apple and with Microsoft, because they trade on roughly, I'm just looking at my numbers, Apple's on about 20 times, and you've got Microsoft.
And Apple hit a 52-week low yesterday. And
yeah, well, I still think it.
And that takes a big, 6% of the S&P that takes up, so that's going to affect that indices as well. Yeah, absolutely.
Yeah, and I think it still needs to take a big bite out of its share price still to go to coin the pud. And why do I think that? Well, basically, it's on a 20 times PE ratio. Well, earnings are only growing really around about high single digits. So it looks elevated in terms of a PEG ratio of over 2. And likewise with Microsoft, it isn't quite as expensive, but I can see that one coming down. And my fair value for both of them is around about 20 to 30% less than where they currently trade. And I'll put this on, as a chart when we do the video and stuff. I'll chuck that on so people can have a look at it. And so when you run down that rule, you've still got your mega cap, your two biggest stocks, your sort of $2 trillion sort of dollar market cap sort of businesses, still got to come down. But then on the other side, you've actually got some really beaten down sectors, and it comes into my sort of like, value territory. And you look at sort of like Alphabet or Google, and you look at Meta and Facebook, and Meta trades on about next year's earnings 10 to 11 times earnings. And likewise with Alphabet, it takes about 13 times. And then obviously the giants in digital advertising. This is where you come to your call in terms of where the economy is going. Because if we're going through a hard recession, which I think a lot of the economists are saying, then actually probably, even though there's really low multiples. This could be a value trap in the short term, simply because there's going to be a lot of corporates and companies who are just not going to advertise. They're just going to take that dial down, and that's going to hit those guys. But in the long term, if they do have secular growth, which these guys do, then there could be a decent recovery play. And I would say, I mean, I've run the fair values likewise, and I think there's 20% upside longer term, over a 12-month view for Alphabet. And I think there's actually around about 50% potential upside for Meta if once we get through this sort of like, this tough sort of like advertising sort of like scenario. And they're not my preferred plays, but they are. It's what's quite, the point is what I'm making. This is turning into a stock pickers market. And if you look away from the sort of like, your Apples and your Microsoft, your real defensive, expensive type of stocks, which I think that those will come down. If you look away from those, there's good value elsewhere.
Yeah. Well, do you know what? I think this is like, this is why I've largely, gone to cash a bit. So we talked about this last time. I mean, you've got to be patient, I think. It's not going to happen, in a few weeks or maybe even a couple of months, but there's a chance to upgrade, like you said before, your portfolio here. There's lots of good companies out there that have taken a knock, and they are very good, efficient companies. We talk about the UK house builders. They'll get back. It may take a while, but they'll get back to their prime eventually. But yeah, it's a very good chance to pick up some stocks for long-term holders that are very successfully, highly efficient, cash generative businesses paying dividends. And, you're holding on to these for 3-5 years and you'll see a decent return, I think. So that's what I've been sitting here on I've had spare time the last few days, and I'm going through ideally how I want my portfolio to look. And I'm talking still a maximum amount of about 10 stocks, because, I think that's enough to be doing homework on. But I mean, top 3 will be mega caps or big caps in the UK. I'll have another 3 sort of like growth stocks, cash generative, but don't pay dividends, but they're growing very well. And then I'll still have 3 sort of micro cap space and that. But so I'm swaying more towards higher quality, more visible businesses, more predictable businesses. So I think it's a good chance here. I mean, and I'm not saying get all in cash now, because we've largely seen the big fall, but we may have a few rallies. Who can tell? We said, when everyone's on one side of the boat, the market tends to surprise people because all the sellers have sold, and even some buying liquidity pushes the market up. So you may see some aggressive, bear market rallies where you can exit any positions you don't want to be in, and then just sit there for a while and just monitor the markets, and I'm looking at companies like Persimmon.
Okay. So have you pulled the trigger at all?
No, I haven't. No, because technically, I mean, I've seen oddly, I've had a couple of alerts on charts. I set alerts on charts as well. I go through fundamentals, look at charts, and I had a little chart for Taylor Wimpey today, Barrett, and just basically the 50-day moving average crossed at 100-day. That is not a long-term trend. They've done that before, so they could take a leg lower. And so I don't want to get in now and see them take a leg lower, because we don't. And we got to say though, the market and the economy, they don't run in sync, do they? And we've often seen when official recessions are announced, that's the bottom of the market pretty much, so it's a good base for form. But as yet, we haven't had an official announcement. Have we have a recession in the UK? I don't think yet. But,
no. You raise a brilliant point. Yeah, I mean, they're not in sync, the economy and the stocks, and the stocks have had a full of like a recession anyway. But there's still probably worse to come in the economy. Now I've got a bit of a Brucey bonus actually, because myself and John Hewman are going to have a real deep dive on all things house builders next week. So we'll publicize that probably the back end, and you can have a good look at it. But we'll be looking at the sort of multiples and the different sort of opportunities there, and not wanting to sort of like be accused of being off my rocker like you sort of stuff. Being on that other side of the boat that everybody's sort of leaning on is probably not a stupid thing. And I'm with you. I think sort of there's good value in those house builders, no doubt about it. And I think, as I say, I think there's good value in long term in even things like Alphabet and Meta and stuff. And my preferred sector, there's 2. I've been banging the table on going sort of like best in class technology, etc. And the 2 sort of real good sectors that I love are healthcare and software. Now healthcare actually has run up quite well just recently, because it's another defensive expensive, so I haven't really found that much great value there at the moment. But I would say software, there is plenty. And what I like about software is that if you go for sort of like, enterprise software that gives companies productivity savings and is on secular tailwinds in terms of long-term growth, has got recurring revenue streams, then if there's a really hard economic, dropout, then these guys will do well because of the helping companies strip out cost. And if the economy does get better, they'll do well anyway. So you've actually got you've balanced your ship there on sort of software, but not all software stocks should be treated the same, because some of them are still really expensive on 10, 15 times sales, but others on the small cap on AIM, you can get them for 2 to 3 times sales on good profit margins as well.
Do you know what? It's funny because I've been looking a lot more at sort of larger cap stocks. Like I say, I want to have about 3 sort of almost FTSE size company, FTSE 100 size companies, and 3 sort of growing stocks between sort of, I suppose, 100 million to a billion, something like that. But in there, actually, I've already got filled 1 slot with Argentex. So that's 1 in there in the mid sort of section. But I mean, you're still seeing if microcaps come out with trading updates that are not meeting expectations, not above, they still get hammered. And I've seen big drops happen of late.
Well, one of those. Let's just talk about one of those, because there was one in over Christmas, wasn't it? Was because we've talked about it, Harland and Wolff, in terms of they've got that brilliant sort of like contract with the
1.6 billion pound contract. That's sitting in the background, which is quite nice, and it rallied up crazy on that.
Fabulous, fabulous.
Yeah, exactly. It doesn't get better than that, and then all of a sudden, it was over Christmas, so I sort of did read it, but I noticed it wasn't welcomed, and if I go off memory, wasn't sort of expecting revenues like 40-50% lower than actual expectations. So it then went up. It ran into. Look at the chart. It's an amazing chart. It went from 6 pence up to 28 pence, and then it sort of sloped down to about 19 pence, then dropped down to about 15 pence, or even 12 pence. So it's very volatile in the last few months, but it's in the background though. You've got I suppose you've got to have nerves of steel in the microcap space when you're in a bear market, because you understand it's sitting in the background is that 1.6 billion pound. It's not all for them, of course, consortium, but they'll get a decent slug of that. But so I don't know. Did you read the update? It's like a roller coaster ride of a share price. That one, good.
Yeah, I know. Yeah. I was actually quite encouraged that they've expanded their facility, their debt facility, which says to me is that people are actually very willing to fund this because of the large contract that they have out in place and the forward order book, which is all covered. It's just a matter of timing before they deliver it, and as long as they've got the sort of cost sort of like bucket sorted out, then they'll make good money over time. And if it just happens that some of the orders some of the actual delivery of it have been shifted from one period to the next, then frankly, who cares? In my view, it's all going to come down to execution, isn't it? Really, in the end. And if they can, and what's beautiful about those type of contracts, I would have thought, is that not only are you going to get the build revenues in terms of the sort of like ships and vessels and stuff like that from the MOD, but likewise you're going to get quite a lot of recurring revenue streams off the bat, because these are sort of like things which are going to be in the the MOD's portfolio of things for years and years and years. And if you can enhance that recurring revenue streams, that's where they make a lot of money in terms of the defence. So. Yeah, I mean, it was obviously a knock and a bit of a disappointment, but I would just say, well, that's just par for the course, really, in these terms of large contracts. And when you're on a business that, has sort of like got that firm view going forward, then frankly, to a long-term investor, it doesn't make much difference. In fact, it probably creates a buying opportunity, actually.
Exactly. I was encouraged by that. They were saying a lot of it was down to delays, supply chains, all that stuff, and not cancellations, which is and they say disappointing, but it's still in the pipeline. They're still confident in the pipeline.
Another one. Actually, I've got a big congrats for you, because you got Polarean Imaging, didn't you? They got their flipping FDA approval. So I looked at it and just thought absolutely fabulous, because they really deserve it. I mean, they've been working so hard to finally seal that with the regulator, and the shares actually didn't go up that well. They went up about 20%.
On the day they went up about 48-50%, which I sort of expected them to do. But then that's endemic in this market. People
that
tend
was
to
bonkers,
sell.
isn't it? Because they've come back to 53p actually.
Yeah, and people will and that's it in the bear market. It's like, in a bear market, if this is a bull market, that'd probably be, it'd stay up there and keep climbing where it raised. But people have taken such a big knock over the last 18 months, and they've seen their cash levels and portfolio values go down, that they say, right, I'm taking some profit. So anyone takes any profit on anything that's break even, and that's what happens, and that flips in a bull market. Of course, people just pile into it, and it keeps powering the thing. But you've got sellers matching buyers, and then most of the time sellers overcoming buyers, and so it's all about supply and demand of the shares, isn't it, at the end of the day? And so I've no doubt now that was the biggest hurdle for Polarean. Now comes the commercialization, because
so how big? What's the significance then of getting this in terms of the commercialization? Is it now going to be a long?
They're focusing on America first and foremost. That's sort of the biggest centers out there, and but like I said, it's globally. I was reading there the amount of there's about 55,000 MRI scanners, I think, in the world, and it's basically it's the value add.
I love that.
Yeah,
that's like sort of like singing to sort of like a musician. I just love those data points. Fab.
Yeah, but I mean, I think in America is about of that, it's about 10,000 America. But this is a value add to all MRI scanners, because this can portray, give you images and in-depth studies that nothing else can. There's no tech out there. That's why I've always loved it. And like I said, you've got the highest academic seats in the world looking at using their technology from Oxford University, and they've all the peer-reviewed papers on this. I think they've got over 100 peer-reviewed papers now on their technology. So it was I couldn't believe it when they couldn't get FDA approval. What's going on? And so now it's there. I mean, the hard yards have been done. Now it's commercializing. So I don't know what's happening next. They'll announce some commercialization deals, whatever. But they do have plenty of cash there. But it's right. It's globally significant. Every MRI scanner in the world can be adapted to fit their technology. So it's adaptive. It doesn't replace anything. So I wouldn't be surprised to see some deals with big sort of MRI scanners, manufacturers, and all that stuff coming out. But
particularly the ones which are located in those. Is it pulmonary health? It's basically the lungs.
Pulmonary health. Yes.
It's the ones which are really utilised for that sort of area, isn't it? Yeah. Which will be perfect, I'd have thought.
Now, there's no point looking at brokenness now, because the last one was out a long time back, and it was delayed. So I don't know what the guidance is now, but if you just think the potential. I mean, America spent, but in this area, they spent 150 billion a year in this area, America, and they say it's an unmet medical need. Like I said, they can't even pick up COVID, after effects with current MRI scanners. You can, with Polarean. That's just an example of how advanced it is compared to what's out there. So it is, like I say, you talk about best in class. This is a tech that's best in class, and I'm sure there can be, a lot of demand for this around the world. So it's been interesting to see how it unfolds. But yeah, I mean, at the moment, it's a gift, I think, where the share price got up and come back down, because it's exactly the same price now pre-FDA approval.
I know, it's nuts, isn't it?
Yeah.
I mean, it's a big pat on the back to the management team, and I mean, it's great for the patients. Let's be clear about it, because it'll improve the patient treatments and diagnosis. So
I've got to applaud it's private investors, because I haven't been on Twitter a lot recently, but I did see someone copy me, and also on the chat group I've got there, that people have already looked on the FDA website and seen it had passed, approved before any RNS came in. I know. In between the break, so they couldn't get an RNS out. But about 2 or 3 days before that happened, already investors had picked it up. So you have the power of the investing crowd there. It's very good. Yeah.
Oh yeah. I mean, I think it came out, wasn't it, on the 23rd in the US after UK markets closed, and obviously then you had the 24th, which was essentially the Saturday. You had the Sunday, the bank holiday. You had the Boxing Day. And therefore, the earliest the company could. But you're right, absolutely, it was spot on by the. I mean, I saw it on Twitter as well, but only because of the private investors who picked it up. Now, another one we've talked about is hVIVO, actually, which is the old Open Orphan. They came out with a really good sort of like contract this morning as well for RSV with I think it was a sort of Asia Pacific business.
This is the first. Have you noticed? I mean, it's a very hot area as well. Everyone has got colds. Everyone's got RSV kind of problems.
I've got rid of mine now because I was coughing and spluttering.
I
Albeit
know.
I'm not feeling perfect, but even so.
Yeah, but that just shows how prevalent it is. And I don't know why. I mean, I've had a couple of people say actually that it's because we've masked up and locked ourselves indoors that we haven't been going about as normal, picking up small little bugs, which you wouldn't notice normally, and your immune system would do the job of sorting that out. But because we've been locked up, then we've been hit really hard by these, by this RSV, 5.2 million. And if you just look down, hVIVO there, non-stop contracts like this. I mean, and this is the first one in Asia Pacific, which is very good. And it's RSV, their challenge model, and it's constant news flow. They are, I mean, I think even covered the Midas Touch column.
Yes, they did. Yeah, you're right. Yeah.
But what I like is when you look down a news feed sometimes, and you can just see, contracts being announced. And if you look at that, 5.2 million today. If you go back to like even November, 17 million contract there, and it keeps going. So this 10.4 million in August, and it keeps going like that. And they're constantly very busy, and no doubt this company's heading in the right direction. And there's very sharp guys behind it. And I think John, actually, you mentioned John. I think John's talking to him on the podcast today. So
is he? Oh, okay, good.
Yeah, but
yeah. I saw the sort of the revised broker notes, and yeah, I mean, they're now trading at a pretty good valuation. I think they're up about 5% today. So they're probably on around about sort of 14, 15 times PE for next year, but they've got a big chunk of cash. So if you actually back out that cash, and I think they've got sort of like net cash of sort of 19 mil. So you take that away from a market cap of 82. So you get to about 63 mil. And then you look at sort of like their EPS, which is backed out of cash, is probably around about 0.8. So essentially 62 divided by how many shares in issue? 600. Okay, so that's roughly around about 671 million shares, 62 million.
We are witnessing the inner workings of Paul's brain.
I know. Yeah, sorry.
We speak live.
No, I know. Yeah. Well, I'm just trying to work it. I'm just trying to work it out. That's equivalent to roughly around about sort of like around about 12 times actually if you back out the cash. So that's really cheap actually for a business that's growing so well and winning lots of big contracts. So
Well, and also just if you look at it, and they always state this, it's worth noting. I mean, they have contracts with 4 of the 10 largest global biopharma companies. So out of the 10 biggest, 4 of them are, and it's still a microcap company, and so that validates really the work they're doing if those big companies are using them on a regular basis. So I like them, and Cahill, the guy who sort of set them up, and he's nice. He's come on the podcast quite a lot. But they spun out Poolbeg as well, also very busy, and Cahill's over that. But 2 companies I think worth watching. They both got tons of cash, by the way, and that's one thing I think very important in this market. If if you're not operationally generating cash, how much cash they got is very important. So that's, I mean, first and foremost, it's exactly what I look at straight away. I'm looking at,
well, here's one then for you.
Go on.
Here's one for you, which is a bit of a bigger cap, which is very controversial, actually. So I will throw it out there at the moment, but also topical because it came out with some delivery orders or delivery numbers yesterday. Tesla, it's got $21 billion of cash, and the shares have absolutely cratered, as you probably know, as everybody's been having a go at Elon Musk and Twitter, and likewise. In fact, actually, to be honest, because of the Q4 delivery orders yesterday, which were released, I think the market had already seen that, and I'm not sure some people were actually dealing in the shares ahead of the time. That would be a total conjecture. So I really haven't got any evidence or anything like that. But the shares did come off 10% in December, and really came off hard. And they came out with some numbers, and they fell again today. But if you look at through the lens now, they're trading at roughly, given the share price, they're trading roughly about 20 times PE, but they're growing sales at about 40%, and the earnings per share growth should be 30% plus for the next, however, number of years. And if you run through that, then I actually think we'll put the cash on it. There's actually some upside. So I would put this onto, sort of a stock watch list. If you're interested in all things EV, why not go for the granddaddy? The problem you have with Tesla, is this a car company? If it is, then essentially it should be on a much lower PE. Or is it a data stroke battery stroke, autonomous driving type business and a sort of tech company. And if that's the case, it can justify a much higher multiple. But I think that's where there's going to be a lot of volatility still going forward. It probably still has got somewhere to go. But I know it sounds crazy, and I'm a value investor and a GARP investor, but I would put Tesla on sort of a watch list as, you know, let's just see what happens here, because you know, it is an iconic brand, and yes, competition is getting massively fiercer in terms of existing OEM car manufacturers and new ones, the likes of Rivian and NIO and from the Chinese guys. And so it is getting far more competitive, but their margins are great. They're getting a lot of a tailwind from the Inflation Reduction Act out in the States, obviously from all that, you know, the carbon credits and the credits they can give to their buyers, and their margins are just a first class. I've not driven a Tesla, so I couldn't actually say about the reliability, but lots of people have owned them, and you know, clearly some people like the product.
Yeah, no, I've heard people talking in favour of that. What I would say, I mean, regardless of the fundamental, I mean, I saw a guy on CNBC calling Elon Musk a liar, because apparently Elon Musk kept saying, "I'm not going to sell any more shares," and he's sold twice since he said that.
Yeah,
a couple of times.
True.
A lot of that was down to Twitter. So when he dumps stock, you know, you will have a knock-on effect, because not only the amount of volume he's putting in the market, but also there's just sentiment-wise, people think he's taking the eye off the ball with Twitter and all that stuff. But what I would say is, you know, in that case scenario, just get a bit familiar with charts, because it's in an aggressive downtrend.
Yeah, I know.
And unless that starts to find a bottom there somewhere, then you'll be, you know, averaging down a lot, because unless it starts bumping. Because say, I did point it. In fact, my son owns about $50 worth of the stock, because
really?
I was doing a regular podcast and we stopped for a little while. I said no point doing it in the bear market a little bit. So, but he's obviously down on that. But and I said, why Tesla? So I said, pick some companies in America or brands you're aware of. We went through a few. And so, in fact, one of them holds McDonald's, which has recently hit a 52-week high. It's, of course, cost of living crisis is not a problem there. People can still afford a McDonald's. But the opposite, and he owns Tesla. And he said, well, they're electric vehicles. They are. And he said they are electric vehicles. So even, you know, at that age, the brand is imprinted. It's amazing when you think of it. It's not that old as a brand, but even kids are very well aware of Tesla and them being sort of the best in EVs. So the brand is up there. But like I said, there's that valuation thing, and people, while they're deciding whether it's a sort of internet company or a tech company or a car company, you've got that worry over that. And when the share price is going down, you'll find people saying, well, it's the car company. When the share price starts going up, that company. So I would just wait until it bottoms out, to me, if you want to own it, because it's still in a very aggressive trend. Like I said,
I'm with you. I think
$400 a share in November 2021, and now it's down to 108. And we have seen a very sharp fall off in the last few days. So
I think that's wise words, you know, in terms of that's where the technicals are so strong that it ain't worth trying to catch a falling knife on this one.
It's a falling knife, yeah.
It is, yeah. But there will be going to a time when the valuation is looking extremely good. I mean, I'd point out it's around about fair value. Another one for your stock watch list, which I've got on mine, is and this is the mega cap boys, is PayPal, because that's come off so badly. And you know, in terms of fintech, I've done pretty well out of Equals and Argentex and stuff. Well, this is obviously the granddaddy on the consumer side through its Venmo as well, its mobile payments platform. And that's come down hard. It started to bounce a bit and it's sort of bottomed out. It's trading on around about 16 times PE, but it's growing its EPS at roughly around about 15 times. So its PEG ratio is about 1. And as I say, I think it's around about fair value, sort of $70, $80 per share, etc. So if this one came down, if it was a baby in the bathwater stuff, and the market strategists were right, and we're going to see a big dive, then I would put it into the same sort of bucket. This is a good quality, world-class brand with a sound balance sheet, generating secular tailwinds with pretty big sort of defensive sort of economic, you know, moat, etc. behind it, because obviously it's got that networking effect. Then you can go a lot worse than the likes of Tesla and on PayPal on a big down. And so it's keep these real big stocks, these quality stocks that are just leaders in their industry and will stay leaders forever, not ever, but a long time. and just keep them on your watch list. And then when they hit a sort of like a valuation multiple that you're happy with, then, pick some up, or, that sort of stuff, because you're unlikely to lose in the long term, as long as you sort of take that type of horizon, rather than trying to sort of like just knock the ball out of the park on micro and small caps on just those.
Yeah, well, do you know what? These are the companies my kids own, Fred and Monty. Right?
Are they own PayPal? I'll tell you, your
No,
lads are pretty.
they don't own PayPal.
Pretty bright. Can I recruit them?
Here's a list of American stocks they own, okay? And tell me which ones you think have performed the best. So McDonald's, Microsoft, Disney, Google, Amazon, Costco, Berkshire Hathaway, Philip Morris, Apple, and Tesla.
Yeah.
Now, of those, there are four that they haven't really sold off that much. And
yeah, I'd say Berkshire, Philip Morris, and Costco.
McDonald's and Costco, yeah. So
that was a good guess.
Yeah. So if you own those lot of stocks there, you wouldn't be. I mean, if you equally, exposure to all.
Interesting that they're gone for Philip Morris. Is that because of
vaping? My youngest son, he said, he said that. He said, who does vaping? I said, I don't know if anyone does. I said, Philip Morris must have some kind of exposure to that. He said, all the kids doing that. But you realize, in a downturn, people tend to smoke, or even smoke more if they're worrying. So it's one of those things they never give up. So the revenues don't go down, So but even if you look at some of those companies, like Amazon, how much they've come down. It's odd if you look at this and you plot against the Fed's balance sheet against these companies. We're now at 2019 levels. So they've really started to wind up the money machine and really started printing it after COVID happened. And all stocks pretty much in the S&P turbocharged upwards. And now we're back that. We are now back to pre-money printing craziness. And of course, people, that's the elephant in the room, isn't it? Quantitative tightening. People are not seeing that it's the opposite of what happened in the last 5-10 years. So it's hard to see. As I said, the only thing that'll stop that, of course, is the Fed saying, okay, when the jobs market is taking a hit, let's calm down, or let's stop, and let's stop, quantitative tightening. So there's lots of things going against the markets at the moment. I think just have a bit of patience a little bit, because in the end, the Fed, if it's a difference between prices and people losing their livelihoods, that's a lot more political, isn't it? People lose.
Yeah, but they do have a dual mandate, don't they? They have not only inflation, but they also have growth, which is good. And one thing, just adding on to what the observation you made there, there's some quite good anecdotal information in terms of inflation. We've obviously talked a lot ad nauseum about goods and natural gas prices and stuff like that, LNG. If you look at the over in Holland, they've cut the rollover really hard. So that's all great. Everybody knows about that. And obviously there's lagging effect of the housing and shelter. We've seen that coming through with rental values at the coal face starting to roll over. Well, actually, also, which came out in December, which I hadn't seen, was the Indeed recruitment salary growth rates, and they've started to roll over as well over the last sort of 3 or 4 months. So they're still elevated. They're still about 6%, but they've come down from 9%, and these are on advertised salaries. And so consequently, what you're seeing now is also that's the last sort of like, part of the jigsaw that needs to fall into place. Salaries starting to sort of like, soften off and getting back to that sort of 2% level. And by the end of the year, that will definitely have happened, probably much quicker, because it started to reduce. So I think, coming back to your, coming full circle to what the Fed is going to do, it's pretty certain. I'll be stunned if I think the market's absolutely spot on that they're going to roll over, even though the Fed is saying they're not, because the economy is going to weaken. But then it comes back to your great observation. The stock market has seen this. The analysts are predicting a really tough economic. It's already priced this in. So actually, when you look at it through that lens, when you come to what will the stock market do, then actually I can't see it mirroring the economy, or sort of what I can actually see it, if anything, because everybody's on the wrong side of the boat, actually doing reasonable, being reasonably resilient.
Yeah. Well, the thing is, what's next? Okay, recession. We know that. What's after that? And then that's what the market looks at. And it can only sort of improve. I mean, how long will the recession be? Yeah, but it may last for a while. But, after that, you tend to get, good businesses getting better, like I say, because the weak competitors been taken out, and the good efficient ones take a bigger market share. In fact, what's very odd? I was surprised at natural gas futures. I mean, they're down now.
Yeah, they're about 70. They were set last time I saw about 75 compared to over 300 at the peak. The Dutch natural gas.
Yeah, they're down at almost Russia invasion, sort of
Yeah.
Ukraine invasion, I should say. So
and the oil prices.
yeah. So that's so that'll feed through into inflation figures.
Mm.
So any other stocks you talk about?
No, I would just say, just looking at sort of like, you know, it's going to be a busy month with trading updates for year end. And then, as I mentioned, just on my sort of portfolio, there's equals will be coming out with something, hopefully, you know, in the next couple of weeks. You've got our Gentex in about week 3 or week 4. You've got good quality, you've got really excellent quality businesses as well in places like Avingtraz, which will be the back end of in January, because I mean, that's all things nuclear, and you know, that's something to look forward to. You might even see some good numbers from Kate Box. I know it's their Q3, but I wouldn't be surprised if they've had a pretty good Christmas, because people have been celebrating.
Yeah.
So exactly. We'll wait and see. And then likewise, we've got the other ones from sort of Lords Group Trading, you know, the building merchants, and I think they've done pretty well. Venture Life as well, and that's all coming down to execution and delivery in terms of where they set themselves up. You've got the, you know, you've got portable oxygen concentrator guys at Belluscura as well. And what's really interesting about those guys, and this is worth noting on Belluscura, is that because China's reopened, yeah, they've got an absolute influx, as we all know, we've heard about in their hospitals, yeah, of people who need respiratory, you know, help, etc. Portable oxygen concentrators are fabulous because they allow people to be treat themselves at home outside the hospital if they need oxygen support, which we know people do with this condition. So if they can actually get their deliveries in sync with the requirements in China, and remember they've got a third-party contractor, a massive one in China. If they can get that volume coming out, this could be a real big upside. I mean, I haven't spoken to the company, so I really don't know. But I just think if, you know, this pandemic isn't going to go away that quickly in China, and if they can say they can get some decent numbers together, that could be a real sort of lift off for them. I don't know. Anyway,
Yeah.
we'll wait and see. But it does seem as though it's upside, if nothing else.
Yeah. It's odd. I'm literally at the moment a little bit obsessed with, you know, recovery plays of good businesses that have taken a hit. You know, and I'm just looking around, and there's lots of places that are starting to, lots of companies that are starting to sort of rally a bit that you shouldn't, and that to me is symptomatic of us not being that far from the bottom. And things like, in fact, I was looking recently. Victoria Plumbing, for example. Very well, yeah. And even STS Sofas are rallying a little bit. There's On the Beach starting to rally. And I was thinking, I saw a lot of adverts for On the Beach. I don't own any On the Beach, but I saw a lot of adverts for On the Beach and talking about you know, free lounge, sort of airport lounges, access, and that caught my eye. And I thought they got plenty of cash. They got no debt. They got about 65 million in cash, and they've had a hard time last few years, but they haven't got any debt. That's a good thing. And they've got a lot of cash, and they are operationally profitable. But things like that, thinking, okay, what are people going to be doing more of the next couple of years? And looking at this weather we had lately, I'm dying for a holiday. I'm sure people are booking holidays. And I saw a report on the BBC saying holiday bookings are up. And I'm thinking, it is like that, isn't it? It's like the gym. The gym's always full in January. Same as booking holidays. When you have 3 weeks of constant rain, you think, I want to see some sun somewhere. So good quality companies in these areas, recovery areas, we know have been hammered, but they're going to recover. It's worth looking at, I think, you know, going forward. If your time horizon is, you know, I'm talking about 3 to 5 years, you know, pretty much. But I mean, I'm not saying they'll be up before that. But yeah, recovery. Okay,
plays. So I'm gonna, in that case, I'm gonna put a big picture, sort of like prediction for 2023. Small caps in the UK are going to be up 10% plus in this next 12 months. Okay, but I think large caps will be flat. So I think, meaning small caps are really going to underperform, and they're going to come out of this faster in terms of sort of upside. So,
do you know what? I've been thinking about that recently. I was thinking about getting into a house builder even today because it's starting to rally, and I thought, is this the bottom? I thought, hang on a second, what's going to happen here is they are going to maybe have technical rallies because they've been sold by 50%. But then they come out with trading updates, which probably be a little bit worse, or maybe a lot worse. I don't know. We don't know that yet, than the last 6 months or last year, 12 months, because there are people cancelling because mortgages were being pulled everywhere. So we know the figures are not going to get worse. And they say they are, some of them are down by sort of, it's on bookings, about 30%, something like that. So it's, you know, it's worth waiting because you don't know how the market will take the actual results when they come out, because we know they're not really good. But how will the market react to those results? You know,
it's the outlook that they'll react. I think they're baked in pretty tough last quarter, but If you want to know, then tune in to myself and John next week, because we're going to do a deep dive in all things house builder on evaluation and which ones we like.
I'll check that out. Marvellous stuff. Cheers up, all. Speak in a couple of weeks.